Imagine waking up to a letter from your bank. Your life savings, $297,000 sitting in one checking account, now partially uninsured. You thought you were safe. You thought the government protected you. You were wrong. By the time this video ends, you'll realize something terrifying. The safe amount of money you think you have in your checking account, it might be the exact amount that puts you at risk. Stay with me, because what I'm about to show you isn't just a number, it's a pattern. And if you don't see the pattern, you're next. The IRS didn't set this limit, but they know about it. Your bank knows about it, and they're not exactly rushing to tell you. The number is $250,000. But here's the thing, that's not the answer, because the real answer is lower, much lower. And if you stick around, I'm going to show you the exact amount seniors should actually keep in checking, and the 3-account system that protects you from the thing nobody's talking about. Let's get the facts straight before the algorithm buries this. The FDIC, the Federal Deposit Insurance Corporation, not the IRS, insures your deposits up to $250,000 per depositor, per bank, per ownership category. Sounds simple, right? Wrong, because here's where the pattern breaks. Most seniors hear $250,000 and think, great, I'm covered. But they miss 3 critical words: per ownership category. For example, if you have $250,000 in your checking account and $250,000 in your savings account at the same bank in your name only, you're only insured for $250,000 total. The other $250,000, it's hanging by a thread, uninsured, invisible, until the bank fails. And here's the pattern you need to see. In 2023, 3 of the 4 largest bank failures in American history happened. Silicon Valley Bank, Signature Bank, First Republic, all had one thing in common: massive uninsured deposits. People who thought they were safe, people who trusted the system. The government stepped in that time, but they were crystal clear. That was an exception. Next time, you're on your own. So why do I say the IRS set a limit? Because here's the connection most people miss. The IRS doesn't insure your money, but they absolutely track it. In 2026, with new reporting thresholds, increased scrutiny on senior accounts, and banks voluntarily reporting suspicious activity, having too much in one place doesn't just risk a bank failure. It triggers attention, audits, frozen accounts while they verify your deposits. For example, a single cash deposit over $10,000 generates a currency transaction report. Multiple deposits just under that, that's structuring. That's a felony. And seniors get caught in this net all the time, not because they're criminals, but because they don't know the rules. So now we have a tension triangle. The FDIC says $250,000 is the insurance limit. The IRS watches accounts over $10,000 in cash, and your bank, they're caught in the middle, reporting everything. Most seniors are sitting on a ticking time bomb, not because they're doing anything wrong, but because they don't know the rules of the game. And here's the psychological trap. Seniors keep more in checking because it feels safe. It's liquid. It's right there. But liquid and safe are not the same thing. The more you have in checking, the more vulnerable you are to bank failure, to fraud, to inflation eating it alive, to the IRS asking questions, to scammers who know seniors keep large balances accessible. So what's the real number? Not $250,000. That's the maximum insurance. But keeping $250,000 in checking is financial malpractice for a senior. The real number is $15,000 to $25,000. That's it. That's your checking account sweet spot. And before you click away thinking that's ridiculous, let me explain why this number is actually designed to protect you, not limit you. Here's the 3-bucket system every senior needs. Bucket 1, checking. $15,000 to $25,000. This covers 3 to 6 months of expenses, gives you liquidity for daily life, medical surprises, home repairs. It's enough to feel secure, not enough to be a target. Bucket 2, high-yield savings or money market. This is where your next $50,000 to $100,000 lives. Still accessible, still safe. But earning 4% to 5% instead of the 0.01% your checking account pays. For example, $250,000 in a checking account at 0.01% earns you $25 a year. $25, the same amount in a high-yield account at 4.5%, $11,250. That's not a typo. You're losing over $11,000 a year in missed interest every single year. Bucket 3, protected investments. CDs laddered across multiple banks, treasury bills, maybe a conservative bond fund, money you don't need tomorrow but might need in 1 to 5 years. And here's the kicker. By spreading across different banks and different ownership categories, a married couple can get $1.5 million in FDIC coverage without breaking a sweat. But the checking account, that's your vulnerability point. That's where fraud happens, where scammers strike, where banks pay you nothing, where the IRS can freeze things fastest. Keep it lean, keep it mean. $15,000 to $25,000. But what if I need $40,000 for a new roof? For example, that's exactly why Bucket 2 exists. High-yield savings transfers to checking in 24 to 48 hours. In an emergency, you have access. But day-to-day, that money is working for you, not sitting there losing value. But my bank says I'm a preferred customer with perks. Let me tell you something. Banks love seniors with $250,000 in checking. You know why? Because they're lending your money out at 7% to 8% and paying you 0.01%. You are their profit center. Those perks, they're crumbs. A free checkbook, waived fees worth $15 a month. Meanwhile, they're making $15,000 to $20,000 a year off your deposit. Wake up. But the FDIC protects me up to $250,000. Yes, if the bank fails, if the government doesn't change the rules, if the FDIC fund has enough money. After the 2023 failures, the FDIC fund was drained. They're rebuilding. But here's what nobody tells you. FDIC insurance doesn't protect you from fraud. It doesn't protect you from a 6-month account freeze during an investigation. It doesn't protect your purchasing power from inflation. It only protects against bank failure. That's one risk. There are dozens. Here's what you need to do today. Not tomorrow, not next week. Today. Pull up your bank account. Look at your checking balance. If it's over $25,000, you have homework. Step 1. Calculate 3 to 6 months of expenses. That's your checking account target. For most seniors, that's $15,000 to $25,000. Step 2. Open a high-yield savings account at a different bank. Not a different branch, a different bank. Online banks are paying 4% to 5% right now. Move your excess there. Step 3. If you're married, structure your accounts. Single account in your name, single account in your spouse's name. Joint account together. That's $750,000 in coverage at one bank. Add IRAs, you're at $1.25 million. Add a trust with beneficiaries, even more. Step 4. Use the FDIC's own free tool, EDIE, the Electronic Deposit Insurance Estimator. Link in the description. Plug in your accounts. See exactly what's insured and what's not. Most people are shocked. Step 5. The most important, share this video with every senior you know. Because the banks won't tell them, the IRS won't explain it, and by the time they get a letter like the one I described, it's too late. One more thing. If you have more than $250,000 total at one bank, even spread across checking, savings, and CDs, and it's all in your name only, you're only insured for $250,000. For example, 10 accounts, one ownership category, one bank equals $250,000 coverage, period. No exceptions, no matter what your banker told you. You came here for a number. I gave you $15,000 to $25,000. But what you actually got was a pattern, the pattern of protection. The pattern of how institutions talk in code, how limits are actually warnings, how the people who should protect you are often the ones profiting from your confusion. For example, thousands of seniors right now have $300,000 in checking. They think they're safe, and if another bank fails, and history says it will, they'll be the ones holding the bag.